Hey guys, it's Max. How's everyone doing tonight? It's Max and Jax. Jax just woke up and looked at me. I haven't done a late night with Max and Jax for a while, and I was just kind of bored, so I figured I would do that. Maybe answer a couple of viewer questions or comments about some recent videos. I've had about 4 videos that came out today, but I figured we would also, oh, um, I had a couple of notes. We could talk about a couple of things, but let's start by looking at a chart of the market, is what we're actually going to start with. As soon as I get this screen shared, if you guys have any questions or whatever comments, you can put them in there and I'll take a look at them. Look at this. I don't know if you guys have ever heard me talk about the end of quarter window dressing. They call it window dressing. What it is portfolio managers, if they have a chance, they'll try to run the market up, the indexes up right around the end of the quarter. Sometimes the first day of the quarter too, of the new quarter. But it's called end of quarter window dressing. The theory was if they have a chance and they're able to run it up, their bonus structure lots of times is dictated by probably their performance, and their performance is dictated probably by where the S&P is. So that's called end of quarter window dressing. Well, here's what it looks like. Look at that last half hour bar. Where they just for no reason. And I don't know. I've never worked on Wall Street, and I don't pretend to know a lot about this kind of stuff. Maybe somebody that has worked on Wall Street can tell us, but I think what it is money managers right around the end of the quarter. People do legitimately have money to put to work, and also the first day of the new quarter. So I wouldn't be surprised if this continues into tomorrow. Is all I was saying. A window into quarter window dressing sometimes lasts, the next day also. But anyway, I didn't play it. I didn't have any content on it. I forgot it was the end of the anyway. So I'm not saying anything, but I'm saying it's something when you're trading the markets to always be aware of that it could happen. So now while we're over here, while we're over here, well, I don't want to talk about that right now. Actually, we'll talk about that later. Let's talk about let's answer some viewer letters, or not letters. Gosh darn it! Where is this darn thing? There it is. Okay, let's see what else we can do here. I was going to talk about XVol. I had a video on a fund named XVol, and here it is. It's by Accruance Capital out of Dallas. I thought I had some more information up on them, but I guess I closed that. But this is a really interesting fund. What they do is I'm going to paraphrase it, or I'm going to tell you what I think they do. They pretty much stay invested. They use what's called a replication strategy, where instead of just buying the index, they buy 50 stocks that they think will replicate the index, and they think it maybe has other more positive qualities. Like I think they pick a bunch of stocks that looks like they pay dividends. Anyway, we'll look at the holdings here, but it's a great fund. So in addition to that, they pick 50 dividend stocks and kind of growthy / dividendy stocks, and then they buy VIX calls. But on top of that, they have some type of algorithm or an AI, something called a phase detection engine. And whenever their AI detects that it's in a phase where they need extra protection, they'll buy more VIX calls and they'll buy less in other phases of the market. That's kind of the way I take it. Their performance has been decent. One of my viewers made a comment about it, and we're going to talk about it in a second because it hasn't always been decent. It didn't look so good in 2022, but we'll talk about that. What else did I want to show you guys here? Yes. So here's the holdings. Like I say, kind of growthy, dividendy. I mean, Verizon, great dividend stock. Brookfield, isn't that a REIT, or don't they own a bunch of REITs? Brookfield. They have Best Buy, Was that Washington Fidelity? It's an interesting fund. You know, they have 2, 3, 4% of those. We can look at all the holdings if you guys want to. Gosh darn it, I forgot this was live. Or I didn't forget, but that's just the way stuff works live. Well, I don't know why it won't just open the damn spreadsheet. Come on, there it is. Okay, so here's all the holdings. My apologies. But anyway, this XFOL is an interesting fund. So there's some growth names in there. I mean, Avgo, Broadcom's about as growthy as it gets. You know, we already talked about Brookfield, Blackstone, you know, big Wall Street company, Getty Realty, so some REIT type things, some energy companies. Anyway, you can see they have about 50 holdings: Williams Sonoma, Walmart, Verizon, Travelers, U.S. Food. Anyway, damn good companies in there. It's a really interesting fund. Okay, so what happened in 2022, though? And that's what I got a letter about. Let's see here. Let's do it this way. Let's look at XFOL versus, let's compare it to old XYLD. Or no, let's compare it to ZHedge. Okay, so this is since 2023, but let's go back here let's go back a little bit further. Okay, you can see both of these funds had a little bit of problem in 2022. And here's what I think happened to both of them without looking too deeply into it. I didn't do a lot of research into this, but this happens with these types of funds. So there's funds that are hedged different ways. There's some funds that hedge using at the money protection, like T-Jewel. And so they pretty much hedge out all the downside. But then there's funds that hedge using different techniques, using more like what they call, or they're trying to guard against crisis. They're trying to generate crisis alpha. But there's funds where their hedges rely on more of like an explosive uptick in volatility to pay off. Well, anyway, both XFOL and ZHedge, the market just ground down too slowly in 2022 to set off any of the hedges. And both of these funds lost about the same that the market did, maybe a little less. I mean, I'm not trying to, and they're good funds. They're doing better this year, but you can see in 2021 that XFOL, I mean, lost a little bit, you know, a little bit more than the market, it looks like. But like I say, that happens sometimes. Now let's see what happened to ZHedge. And I don't know the particulars on their strategy. I think ZHedge runs callers, and this other one buys. Let's talk about XFOL, the one I researched today. XFOL buys VIX calls, out of the money VIX calls, based on what the AI engine and the phase detection engine is telling them to do. I have no doubt that the phase detection engine was telling them in 2022, hey, we're in a bear market phase or whatever, but we never did get a big enough explosion from the VIX to have a, for the hedges to really kick in. And so you just have to, always talk about know what you own. So XFOL is a great fund just based on what we know. And if you knew or if you were worried about a black swan type event over the next couple of years, XFOL would probably be a superior choice to something like T-Jewel, and where T-Jewel uses at the money at the money protection, and other funds do that too. They use I don't want to get too into option nerdy, but T-Jewel does a strategy where you just basically you can't lose money. Look, it couldn't. It just, I mean, it was down. You can see in October when was, or that was August. This fund doesn't go back as far, but look at that. The market dropped from 10,000 to 9,000. Just, I mean, in like 3 days, pretty much. I mean, or in 2 weeks or whatever. T-Jewel dropped it looks like about 2.5% over the same time frame. The market dropped 10. So it's a different type of hedging. The problem with this type of hedging is these types of funds don't catch any upside. The good thing about this other type of hedging, like XFAL has been doing, is they catch a lot more upside. Let's look at XFAL, and let's look at XFAL off the lows. So XFAL off the 2022 lows, obviously hasn't kept up with the market. Nothing has, but it's done really well. I mean, it's up 22% in 2 years. I mean, it's pretty good. The SPY's had a great past 2 years. Look at that. The SPY's up 50% in 2 years. That's awesome, isn't it? That's a great time. But in any event, XFAL, that's the idea. They want to be able to catch plenty of upside. That's how it's designed. So we'll see. But like I said, it needs a really vicious drop to set off those VIX hedges. Okay, I got other stuff to tell you guys about. Call spreads. Let's talk call spreads here real quick. Okay, so this is the ironic thing. Okay, you guys know how much I love Jay Pestruccelli's new strategy and how he's put the call spread overlay. It's not really that new. He did it on SPY-T a long time ago. And and I really liked it because it partially uncaps the upside. We talk about it all the time. But anyway, and I think a lot of people have become comfortable with call spreads. And in fact, they do call spreads on just about every yield max stock out there. But I thought it was interesting. I wonder if a lot of people realize this. And if you're into options, you might like this. If not, I'm sorry. But anyway, okay, so this is a call spread itself. And this is and just so I put a real one in here, I believe this is the Airbnb one from this week. They sold the 130, bought the 130. Well, I'm sorry. Gosh darn it. Give me just 1 second. Airbnb, boom. Okay, so these guys, let me put this in real quick. So for this coming week, well, it's Friday, the 4th, they sold the 130 and bought the 133. Now, 135 and 54. Excuse me, I'm talking to myself. Okay, so here is the trade. Here's the trade these guys did. It's very simple. They sold this call right here for $1.35. That's the 130. Okay. So they don't have unlimited loss on the upside if the market starts running up, because they're short the market. Anyway, you don't want to be short if the market starts going up. So they bought a call at 133. This is the way option players do or lots of times, in my opinion, the way option players do stop losses. They'll just put in a spread and they'll just accept that 3 points, the width between the spread is your max loss. Okay. But anyway, so that's a very simple strategy. It costs $300 to put it on for one contract. If you win, you make $81. And all that means is the market doesn't go up more than 3.3%. Okay. If the market goes up 3.3%, this loses. And in fact, it loses a max of $219 if the market goes up more than 5%. Okay. The irony is you want to lose, and you want to lose as much as possible on this one. You don't even care. This spread, this is called a call spread overlay. But the funny thing is, when you do this strategy, you're hoping to add a losing trade every day to your position, because when you do the call spread, you just want the market to be up as far as possible. Let me show you why. Because right here, I don't have the stock turned on. I have the stock turned off. So let's see. Oh, here, okay, we're going to buy the underline. Okay, so here it is with the stock, and this is when it makes sense. So see, you do want, even though the call spread itself is at max loss, you just need the prices to go as high as possible, because primarily you're just invested in the underlying, whatever this is. These types of call spread funds like SPY-T are way more similar to in just investing in a normal index fund, the way people are used to, because you don't have to deal as much with the capped upside thing. But the thing that's ironic about this, I wonder if a lot of people realize, though, on these call spreads, the other thing, it's an uncomfortable truth about them, but they don't give you that much protection on the way down compared to just a covered call. So watch this. So here's a covered call, and this is the old way of doing it. And this way of doing it, you would have made $135. Well, no, you would have made you'd made $135 this way. The new way of doing it, you make $81. Okay, so about 40% less. But of course, the trade-off you're taking is, if the market goes up, you have unlimited upside. But the catch is, the market has to go up, not just a little bit. It has to go up more than 5.1%. And if it only goes up 4% or 3.9, or if you land somewhere in what I call the shelf, then you actually do a little bit worse than you would have done if you wouldn't have just done anything. Anyway, these are just remember, these covered call funds only when you need income, right? That you don't use them if you don't need income, because they do have some unintended consequences. Okay, I wanted to go over this letter real quick. Surf and Wine here. Okay, Surf and Wine said, good example and study. There are so many examples you could do. That's true. I'm going to do some more. What if you are taking no dividends and you drip all income? Would you just buy the underlying index? Okay, so let me think about this. So this person, they're saying, they own these high yield funds and they just reinvest everything. Okay, so part of me wants to say that's great, because when you reinvest everything, you don't have to worry about a lot of the bad stuff that it kind of games the system. We've talked about it. I think you should only reinvest 2/3 to take some to put in your pocket, but maybe this person's extra cautious and they're like, let's just reinvest all of it. That's good. Can you be too cautious, though? Because if you're reinvesting all of it, if you're just reinvesting all of it, then do you really need this income, is what I would say to them. And if you don't really need this income, yes, you are costing yourself money using any of these types of funds compared to any type of normal growth fund, just on average. So, here's the thing. Do you maybe think there might be a month when you might need some income, and maybe you're using this for like an emergency fund, and you could just turn the drip off real quick and then give yourself an income for that month? There's probably better ways to plan for emergencies, but you could kind of justify it that way. And I don't know this person's particulars. Surf and Wine, they kind of sound like a West Coast. They're probably a wealthy Californian. So, and also that goes with me. Also, if you're wealthy, you could afford to have an investment like this and drip it, not worry about the income. But honestly, I think I would just put it in the SPY if I rather than just drip it all back in. And I love these funds, but I think in that case you're better off, or I don't know. I think because then what the critics say are true. They're kind of repackaging your own money, creates taxes and stuff. So that's fine if you need the money. If you don't, I would probably put it back in the SPY or the VU or the VTI or whatever. Triple leverage Qs. Tom Lee says we're going to go up 40% by the end of the year, or I think he said that. Anyway, can you imagine having triple leverage Qs if we do have a Santa Claus rally that kicks in? Ooh, that'd be something else. So I'm going to check the comments and see if you guys have any. Make sure I'm not missing anything. Okay, there's people here. Good. Well, I appreciate you. That was a nice comment. Thanks to you guys for being here. Okay, I'd like to talk to you guys, but I'm just going to try to stay on topic here. I want to talk a little bit about my volatility model. So we're going to look at stock charts, and even if you don't like my volatility model, we're going to talk about which way the market's going, up or down. So I think that's kind of fun. So let's talk about that here for just a second. But yeah, if you guys have any questions in the comments or whatever, I'll look at them in a second. It looked like you guys were just shooting the shit. I'm glad you're here. I appreciate both of you guys for being here. I wish it showed me in my UI how many people were here. I never can see that. Somebody maybe can put it in the comments for me. There's probably like 5 or 10 of us here, but I'm always curious. Okay. So we're going to talk market timing here, which is something I don't really believe in, but I do believe in trends. And so I have a system that kind of tries to follow the market trends. It attempts to do it in 2 different time frames. I wanted to show you the longer time frame. You can see it's this big red box. It turned red right here in July when the market was pretty much at the peak. That was a great signal. This thing, it's a pretty good system that I have, and it looks to see if people are putting hedges on. And anyway, it saw hedges come on there, and sure enough, that was right before the market went down. In late July, it went down pretty good, and then it bounced. But then, like August 1st, 2nd, and 5th, it pretty much, it was pretty vicious. A really vicious pullback. Well, anyway, it caught all of that. The thing is, it hasn't turned back green since, and the market has actually gone a little higher than that. So my system is calling BS in the bigger time frame, in the daily time frame, which is what this is. And this tries to capture the broader trend. You can look at it. Look at the last time it turned green. It caught a broad trend. Look at the time before that. It turned red. It caught a nice pullback. Look at the time before that. Yes, you can't time the market, but also people can't help the market trends. So if you're cognizant of the trends and where you are in the trends when you invest and when you allocate tactically, it's something that puts you at an advantage over other investors. So you can see that was a great trend. But then back here, we were talking about XFAL and saying they didn't catch very much of the downside in 2022. We could see how much this trend would have caught. I mean, this thing would have caught. And here's the thing: I can tell by looking at this. A lot of systems, trend following systems and volatility systems, didn't work in 2022 or didn't work that well because everything was down. And people talk about it. Every system was down. I mean, it was just a kind of a crazy market. It was a crazy market. This my volatility system in April of 2022 switched negative with the SPY at 437. Then it didn't switch back positive till July 25th. The SPY at 393. So that wasn't bad. And then it caught a little counter trend rally, but then it switched negative. The SPY at 410, and the SPY dropped to 384. And that was a switch negative in August 29th. And then it stayed negative all the way through October. And then it was clear sailing from there. And it's been pretty much clear sailing from that point on. We had a little pullback in October of 2023 also. And this thing went negative at 425. And by the time it went back to positive, it was about 425. That one wasn't that good of a signal. The market did go down, but unless you got out at the very bottom. But in any event, but then this next signal was incredible. So I just like to try to stay cognizant of where the trends are. And this factors in volatility, which factors in if people are putting hedges on or taking hedges off. All right. I hope you guys like that. What else should I talk about? Well, I think I've talked enough. Let's see what you guys had to say. I hope I have a drink. I got a drink. By a drink, I mean an HEB sparkling water. All right. I appreciate you guys being here. I'll go from the bottom, I guess, or okay. I have done a lot of shows today. I got behind. I got sick and caught COVID a couple of weeks before, and I wrote a bunch of scripts. In fact, I have a script right now that I need to give that, but I don't know. I was going to give it on this show, but I figure I'll do it tomorrow or whatever. But here's a preview of it. Max is maximum on risk. In the same way a hound dog exerts as little amount of effort is needed to survive, an investor avoids risk. My slides are all jacked up for some reason, but in any event, I'll work on those slides. But I have some good presentations, but I had about 5 presentations that I wanted to give, like on XFall and on, all the ones I've been giving lately. And I'd had them written and the slides made and everything. I just needed to shoot them. So I got sick and I got behind, but then the past couple of days, I've been getting caught up, as you could tell. So yeah, I've done a bunch of videos today. It'll probably slow down now. I've got caught up. So let's see. Yeah, Summit Man, I appreciate you for being here. Summit Man's one of my good favorite commenters. We talk all the time in the comments, don't we, Summit Man? I'm just making sure I didn't miss anything in the comments. Yeah, I know. I'm trying to stay on topic. Okay, well, I did pretty good, so I have to see. Here's my topics. Okay, so the last one was the vol model. I'll go over it. I want to talk about XFall. We talked about XFall. I wanted to talk about call spreads and about the uncomfortable truth that call spreads. And it's not really an uncomfortable truth, but about you're rooting for the call spread to get beat every time. And the other uncomfortable truth is they don't give you that much downside protection. Not compared to just a regular covered call. So these are going to drop more. In the same way Defiance drops more than, or the same way Roundhill drops a little more than Defiance, the Defiance funds that do the call spreads like SPY-T will drop more than the Defiance funds that just do the covered calls. But anyway, I do think the calls, but having said all that, 2 things can be true at the same time. 2 or 3 things can be true at the same time. I do think the call spread top to bottom is an overall better plan for doing it, especially when you consider the way a lot of people are using these, because I think a lot of people are using these more like a quasi growth. I mean, they're using it for income and growth anyway. So the call spread gives you the ability to get some income and growth. Sorry, I didn't mean to do that. It's a genius plan for Jay to embed it. I need to talk to the guys over at XFall and maybe try to get him on. I really like that. I really like that ETF, and I would like to learn more about their VIX option strategies. If you guys would like that, maybe I can see if Rob would come on the show. I don't know. All right, so let's see. Summit Man, do you have a question here? All right. Hey, Max, if you look at T-SPY since inception, it beats the SPY. I haven't seen that yet. I haven't looked at that lately. Curious if it will continue. Imagine a SPY return plus a 5 to 7% yield. Yeah, that's something else. You know what I'm imagining? What I'm imagining is SPY-T giving you a close to SPY return with a 20% yield. But yeah, I mean, this T-SPY would be really sweet. Okay, I haven't seen that yet. Maybe we ought to just check out T-SPY real quick. T-SPY versus the SPY. K-Triple-Q, I bet it's doing pretty good against the NASDAQ. We'll check that out next, but it's the same type of high-powered fund. Lots of times you see GPIX or Bally when you pull up a comparison. Lots of times they're beating the index. So, it's not like it's impossible to beat the index, but you just shouldn't. You definitely should expect to beat it. I'm happy if my high yield fund gets 3/4 of it. I mean, I think that's a victory. But yeah, when you're getting all of it, that's great too. Like you say, plus the 5 to 7% yield. Okay, so yeah, look at this. Look at that, 4.2 to 3.6. Okay, I need to have old Cy on here. I wonder if he'd come on the show again. Anyway, I need to try to get Cy on and maybe the guy from XFall. And I can have the guy from XFall talk about VIX, and we'll just see what Cy has to say. Be interesting to see what kind of dividend he pays. I tracked it for a few days, and I looked at some of their calls, and I looked at some of K-Triple-Q's calls also. K-Triple-Q worried me a little bit. They didn't look like they were selling enough calls. They didn't look like they're going to pay that much. Let's do this, though. Let's look at K-Triple-Q. Let's see how they compare to the Triple Q. Damn. Look at that. I mean, they're not beating it, but I mean, come on. Give them a push there. I mean, yeah, if you can get market returns and make 5 to 7%, I mean, I'm always saying there's no free money, but there are things you can do with option strategies where you can get, you can get money that's not free, but heavily advantaged money, I guess. All right, let's see what Summer Man's yapping about down here now. What are you saying there, Summer Man? Maybe the best for total return is aiming for capital appreciation. And yeah, and only 5%. Yeah, I think you could do 5 to 7. I've said for a long time that 2/3 was the magic. Take whatever fund it is. Look at the magic. Look at the secret to success, longevity of Global X with XYLD. Look at JP Morgan, and they publish how much they capture versus how much they pay. Global X does, and they just pay half of what they capture. I think they're, for them, the magic number's half. When I did calculations on it, I think you could really get away with 2/3. I think half is like super duper safe. Global X is like an extra level of safe, and so is JP Morgan. But I really think 2/3 for the moderately aggressive investor, and that still gives you money where it still gives you protection, or, it still keeps from cannibalizing your investment too much. But at the same time, it gives you money to spend. You have to be paid for the risk you take. These are risky because of the money you leave on the table not being in growth. Even if these didn't decay or, 1 penny, there's a huge opportunity loss in using income. And they don't, and that's the thing, and they don't always decay, and you can't count on decay. Oh gosh, somebody's calling me. Okay, I'll call them back. So anyway, all right. What else do we have to talk about? Well, I just mainly want to talk about if I just would really not, even though I appreciate the enthusiasm, I just am not into the idea of reinvesting of all the dividends, even though it's a smart thing to do, just because there's probably better uses of capital. But anyway, all right, what's Tony saying here? I started using my own mix of XDT, SPY-T, and JEP. Well, that's a trio right there, depending on the day, one of the day. Yep. I like that, Tony. All right. Summer Man, I'm with you. I'll try to get that XFall interview going. All right, guys, I got to return this call that I just got. So I'm going to get out of here, but I appreciate you guys for being here. I also want to see who's at the door. I think someone's hit the door. All right. You guys have a great day. See ya. Hey, thanks for being here. Seriously.